Welcome to Talk Tickers. We dive deep into earnings calls so you don't have to. Today, we're dissecting the latest report, really zeroing in on what matters for this company's performance and its path forward.
Yeah, this past quarter presented a pretty fascinating snapshot. I mean, while the initial headline showed a slight dip in net sales year over year, down about 2.3% to $1.85 billion, the underlying story gets clearer when you adjust for a couple of key factors.
Okay, let's unpack that headline then. What are these key factors we need to consider?
Well, firstly, currency exchange rates. They definitely had a noticeable impact. If you factor that out, their net sales actually saw a small increase, 0.7%.
Okay.
And secondly, their alcohol segment saw a bit of a downturn. Now, if we set that aside for a moment, the growth in their core business was actually more like 1.9%.
Huh. So it sounds like while that top line number might cause some initial, concern, digging a bit deeper reveals a more stable core business. It's been showing some growth.
Exactly. And, that picture of underlying strength, it's backed up by their profitability. The gross profit margin improved quite nicely.
Oh, yeah.
Yeah, it jumped from 54.1% last year up to 56.5% this quarter. And this improvement mostly came down to successful pricing strategies and, getting more efficient in their supply chain.
Right. A healthier gross margin often translates to good news down the line. Did that hold true here?
It did, yeah. Their operating income also saw a lift. It increased by 5.1% to $569.7 million.
Okay.
And just like with net sales, if you exclude that alcohol segment, the operating income growth was even stronger, 7.9%.
Wow.
And the bottom line also reflected this positive trend. Diluted earnings per share rose 7.4% to $0.45. And again, excluding alcohol, it was up 10.2% to 47 cents.
So that initial sales decrease seems to be masking a more positive reality, really. Improved profitability, underlying growth in the main business. And it looks like things picked up even more recently.
Yes, definitely. The company highlighted very strong sales momentum as the quarter went on. It actually culminated in an estimated 16.7% increase in April on a foreign currency adjusted basis.
16.7, that's significant.
It is. And excluding the alcohol brands, that April growth jumps to an impressive 17.6%. It really suggests that some of those earlier headwinds might be, easing up.
Now, let's really get into the weeds here. What were the specific factors that influenced those first quarter sales figures? It sounds like it wasn't just about what consumers were, grabbing off the shelves.
That's right. A big factor was the ordering patterns of their bottler distributors, particularly in the US and the EMA region, that's Europe, Middle East, and Africa.
Okay.
The timing of when these distributors place their orders, it can create these temporary swings in reported sales that don't always line up perfectly with, say, consumer demand right at that moment.
So it's maybe more about inventory moving through the supply chain than a direct reflection of consumer appetite at that exact time.
Precisely. And we also can't overlook the currency impact, which, as we touched on, had a $57.3 million unfavorable effect.
Right.
And then there was that decrease in sales within their alcohol brand segment we mentioned. They also noted some smaller impacts from bad weather and just having one less selling day in the quarter.
But it's important, I think, to underscore that despite all these different headwinds hitting their reported sales, the underlying demand from consumers seemed pretty robust and actually accelerated through the quarter, right? Leading into that strong April.
Absolutely. I mean, while these other factors can create noise in the short term, that consistent growing consumer demand is really a key indicator of the fundamental health and, the appeal of their products.
Speaking of their products in the wider market, the energy drink category itself seems to be going strong globally. What trends did they point out there?
Yeah, the basic drivers for energy drinks are still quite positive worldwide. We're seeing more households buying them. That's the increasing household penetration. And those who already buy them are buying them more often. So that leads to a rise in per capita consumption.
Yeah, that makes sense. Fits with, busy lifestyles, people wanting that convenient energy boost.
Yeah.
How are they performing within this growing category, though?
Well, in the U.S., the energy drink category saw pretty substantial growth, 10% in the 13 weeks leading up to April 26th. That's according to Nielsen data.
10%?
Yeah. Now, looking at their specific brand performance in that same period, their main energy drink brands, including Bang, collectively grew by about 6.9%.
Okay.
Their sample brand showed particularly strong growth, 8.7%, while Reign actually saw a decline, 9.9%. NOS was up slightly, 0.8%, and Full Throttle was down a bit, 1.5%. It's definitely worth noting that Red Bull saw a very significant increase, 15.6%. during this time.
So kind of a mixed bag within their own portfolio then. And it looks like they're facing some pretty strong competition, especially from Red Bull in the US. How did all that impact their overall market share?
In that really crucial U.S. convenience and gas channel, yeah, their market share did see a slight decrease. It moved from 37.1% down to 36.4%.
Okay.
And like we just said, Red Bull seems to have gained significant ground there.
And what about that sort of evolving coffee plus energy drink segment? What's happening there?
That's an interesting one. While the overall category saw a slight dip, their Java Monster brand actually saw increased sales.
Oh, okay.
Whereas Starbucks' energy coffee sales declined. So consequently, their share within that specific coffee plus energy drink category actually improved.
Huh. It's fascinating seeing these like micro battles playing out in different segments. What about internationally? How do they fare outside the U.S.?
Internationally, they reported strong growth on a currency-neutral basis in places like Canada, Mexico, and EMA. They also managed to gain market share in several European countries, plus Australia and South Korea.
Good signs.
Yeah, but on the other hand, they did see market share declines in some significant markets. Think Brazil, Chile, Argentina, France, and Japan. So, a varied picture globally. Strong performance in some spots, offsetting challenges elsewhere.
Let's circle back to that gross profit margin improvement you mentioned, which sounded pretty good. Beyond pricing and supply chain stuff,
Okay.
were there other factors helping that?
Those were really the primary drivers they highlighted. They did also mention a slight decrease in overall running expenses.
Okay.
Although, as a percentage of their net sales, operating expenses actually ticked up marginally. Interestingly, though, distribution and warehouse costs decreased slightly as a percentage of sales, and their effective tax rate stayed relatively stable.
Got it. In today's world, you always have to ask about tariffs and raw material costs. What did they say on that front?
They indicated that the impact from tariffs wasn't really significant in Q1. However, they are keeping a close eye on the rising costs of aluminum, specifically what's called the Midwest Premium.
Right. That's been a factor for a lot of beverage companies.
Exactly. And they're actively looking at ways to mitigate this potential headwind. One thing they mentioned is developing a new flavor and concentrate facility down in Brazil, which they expect to be up and running late 2026.
Okay. Sounds like they're being proactive there. Now, innovation is, well, it's the lifeblood of this industry, right? What new products did they launch recently? What can we expect?
Oh, yeah. They had a really substantial number of new product intros in the first quarter across various brands and regions, too.
Like what?
Included new stuff under Reign, Bang, Monster Ultra, Juice Monster, Killer Brew, Monster Reserve, Monster Rehab, Burn, and even the Predator Fury lines. So quite a lot.
Busy quarter for launches.
Very. And while Q1 saw maybe a higher concentration of those launches, they do have further innovation planned for the second half of the year.
Okay. Let's just revisit their alcohol brand segment quickly, because that seemed to be dragging down the overall sales numbers. What's the story there?
Right. Net sales in alcohol did see a significant decrease. They mostly chalked this up to the very strong launch of their Nasty Beast tea in the same period last year.
The tough comparison.
Exactly. It makes for a tough year-over-year comparison. But they are actively working on new products here. They're launching a new flavored beer called Michi nationally, and they've got plans to take their Beast brand international. Plus, we can expect more innovation in their sample brewing portfolio.
And what about capital management? Returning value to shareholders? Any share buybacks in the quarter?
No shares were repurchased during Q1. However, they do still have about $500 million remaining authorized under their existing share repurchase program.
Okay. So looking ahead then, what's the overall outlook? I mean, those strong April sales certainly seem like a positive signal.
They definitely emphasize those positive April trends. They also indicated they'll continue to look for opportunities for, strategic price adjustments, both here and internationally.
Makes sense.
And their core strategy really remains focused on driving growth through ongoing innovation, strengthening their brands, and really leveraging that extensive reach of the Coca-Cola bottler system.
And finally, there was a pretty notable announcement about their management team, right?
Yes, that's right. One of their co-CEOs will be stepping down from that role after the shareholder meeting in June. It marks the end of a very significant 30-year tenure in that specific position.
Wow, 30 years.
Yeah, though he will remain with the company as chairman.
Okay, so to kind of bring this all together for everyone listening, what would you say are the most important things to really take away from this earnings call?
Well, I think the key takeaway is that while that initial reported net sales number might have looked a bit underwhelming, it's really crucial to understand the factors behind it.
Yeah.
That difference we saw between the reported sales and the much stronger retail data, it strongly suggests that those temporary shifts in distributor ordering had a pretty significant impact. It just highlights why you really need to look beyond just the headline numbers sometimes.
Absolutely. It really underscores the value of doing this kind of deep dive, getting into the details.
For sure. And furthermore, the underlying strength and importantly, the continued growth of the core energy drink category, even with broader economic uncertainty, it positions the company in a pretty resilient market segment.
Right.
However, we definitely need to keep a close watch on those market share dynamics, particularly the increased competition they're facing in the US C&G channel, and their success internationally will be critical going forward.
Okay.
And finally, their focus on improving profitability through pricing and supply chain optimization is clearly paying off, although, they will need to manage those rising aluminum costs effectively.
Okay, great summary. Now for our This Is Not Financial Advice segment, time to put on our speculative hats and maybe brainstorm an outrageous but plausible trade idea based on all this.
All right, let's try one. So given that strong rebound in April sales, especially if you strip out the alcohol part, and their stated focus on expanding those affordable energy drinks like the Predator brand.
Yeah, in developing markets.
Exactly. In large developing markets where price sensitivity is, a really key factor. Here's a thought. Maybe consider taking a long position in this company while at the same time taking a short position in a competitor that's maybe more focused on premium priced energy drinks, primarily in mature developed markets.
I'm just going to play. What's the thinking behind pairing those two?
Well, the rationale is that the market might be underestimating the growth potential of that affordable energy segment in those big emerging economies. If this company really succeeds in capturing significant share there with their value brands, while maybe the growth of premium brands in more saturated markets starts to slow down,
then the trade could work out.
Yeah, this trade could potentially capitalize on that divergence in growth trajectories and the short position in the premium competitor. That could also offer a degree of hedging if, say, those U.S. market share concerns for our main company linger longer than expected.
Bold, but definitely has a logical thread running through it. As always, though, remember everyone, this is purely a hypothetical scenario. It's for discussion. Absolutely not a recommendation to trade. You really need to do your own in-depth research before making any investment decisions.
Absolutely. So to sum up this earnings call, it really presented a complex picture. You had reported sales facing some temporary headwinds, but the underlying consumer demand for their core products looks strong, and they're making real progress on profitability, monitoring their market share, how they manage costs, and the success of their innovation pipeline. Those are going to be the crucial things to watch going forward.
We definitely encourage you to check out the full earnings call transcript and, of course, conduct your own thorough analysis. We're always keen to hear your perspective, too. What are your thoughts on the potential for affordable energy drink brands to really drive growth internationally? Let us know. Join the conversation online. Thanks for tuning in to Talk Tickers.